Hello, this is Mike with the NetPicks Options Academy. This is the trade of the week for Thursday, December 3. So what I want to do in this video is kind of walk you through some of my approaches to the markets and some of the criteria that I look for when setting up trades and trying to identify new trades on a daily or a weekly basis. So for many of you, and I talk to traders on a daily basis, so I hear a lot of the common approaches to the markets. A lot of people just like buying calls and puts if you're trading options, and that may work well in certain cases. But we don't want to just limit ourselves to that, because if you're buying long calls or long puts, you're basically throwing down a strong directional bet. Okay, you're hoping that the market's going to make a big move in your direction. But we all know that the market doesn't always make big moves. So what else can we do to open up our playbook, give ourselves a little bit more opportunity to make money on a consistent basis? So what I've done here is I've loaded up Thinkorswim. This is the charting platform, the broker platform that I personally use. I clicked on the Market Watch tab here at the top, and then I selected quotes. And I've loaded up a watch list. These are the products that I look at on a daily basis. It's my universe of products that I look for. So I'm not scanning thousands of names on a daily basis. I'm looking at the same names consistently. And one of the main data points that I look at for each product is I track volatility, specifically implied volatility. Because I'm trading the options, the volatility has a big impact on the pricing of an option. So if volatility is high, the options are going to be pretty expensive. If volatility is cheap, the options are cheap. Okay, so you can see this column here that I have loaded up. It's called IV percentile. And what that's doing is it's taking a look at the volatility across each product that I look at. So if we have USO here at the top of our list, and you see the IV percentile of 61. What that's doing is it's a number that's looking at the implied volatility that's being used to calculate the prices of the options on USO, and it's telling us, okay, where's the current level of implied volatility compared to the last 52 weeks? So if this IV percentile is at 60, it's telling me it's in the upper half of where things have been the last 52 weeks. So the volatility is actually a little bit elevated compared to where things have been over the past year. Okay, so if I take that approach, I know that, okay, if the volatility is elevated, the options are a little bit more expensive. Maybe instead of buying options, maybe I want to sell options. Maybe I want to sell a call spread or sell a put spread, for example. That way I can collect the premium up front. I can get paid up front. That way I don't have to require the market to make a big, quick directional move in my favor. If you buy a long call, for example, that market has to move in your favor. It has to move up, and it has to do so quickly for you to make money. Okay, if you sell premium, as we'll see here in a moment, it takes some of the pressure off. You don't necessarily need that strong directional move overnight in order to be successful. So if I've already loaded up all the names on my list, I've sorted them by high implied volatility. So you can see it goes from high to low. What I do is I kind of draw the line in the sand at the 50 level. Anything that has an implied volatility percentile above 50, it's telling me that the volatility is slightly elevated. That means anything above 50, I can go in and look to sell premium on. So the top name at the list on the list here is the USO. It's an oil ETF. We all know that oil's been super active. Even if you haven't been trading here of late, you've probably seen it when you fill up your car at the pump, right? A lot cheaper to put gas in your car, correct? So the price of oil has been all over the place. Here lately, it's taken a big leg to the downside. So USO is a highly correlated product to the price of crude oil futures. Okay, if you see /CL over here on the left-hand side, that's the futures market. I know a lot of people don't like to trade futures. So by looking at USO, it gives us some access to the energy markets without having to look at the futures. You can do so with a lot less money. As you can see here in a moment, we're going to talk about taking a trade for less than $100. Okay, I love the leverage that the options offer. Okay, so I've already established the fact that we're going to take the opinion that the volatility is elevated on USO. Okay, next thing I'm going to do is I'm going to pull up a chart. Okay, so this is just a basic daily chart. It's got a couple of pretty standard moving averages on it. Okay, just a couple of simple moving averages, a couple of exponential moving averages. You don't even necessarily need those. All I'm looking for here is overall trend. I need to determine, do I want to be bullish, bearish, or neutral? Because that's going to impact what type of trade I go to. Okay, so if I look at this chart, you can see, no doubt about it, we've gotten beat up on USO. We've taken a big leg to the downside. I mean, we came from the 20s all the way down into the 1237 area. So we've seen a big move to the downside. So I'm taking the approach based on this chart that in the near term we could potentially be a little oversold. I'm not saying the bottom is going to be in and that we just zoom right back to the upside, but in the near term, wouldn't be surprised if we see a bounce to the upside. So if we go back to the low back in August, you can see that we got to a low of 1237. We actually tested that level yesterday also. Okay, so if you're a technician, if you like to look at the market technicals, we may have a double bottom here, right? So for me, instead of just wanting to go in and buy a call option to play the move to the upside, what else could I do? Well, we just mentioned a few moments ago the volatility we believe is high. Okay, and that's not a surprise, right? I mean, typically when the markets head lower, the volatility increases, right? Turn on CNBC and they make it sound like that's a bad thing. It's actually a good thing. It opens up our playbook. So we determined that volatility was high. We've now taken a look at the chart and we say, okay, I want to play a move to the upside. I want to see if USO bounces. So what are my options? Could I buy a long call? Well, I could. Could I buy a call spread? They're both bullish plays. The problem there is we're going to have to pay to put those trades on. And the only way that those trades make money is if USO moves to the upside. And if it moves to the upside quickly. Okay, so the clock is ticking when you buy an option. We're going to flip that whole scenario around. Instead of buying a call or buying a call spread, we're actually going to sell a put spread. A lot of times people hear about put options and immediately they think about, if I'm playing a put option, I want the market to head lower. But we're selling this put spread to open up our position, so we actually want USO to head higher. Okay, so I looked at volatility. The volatility was higher. Okay, it was above the 50th percentile. We then looked at the chart. We want to play a short-term bounce in USO. So now let's go to the trade page. Let's price some things out here a little bit. Okay, so the first thing I have to decide on, what expiration cycle do I want to go with? The December options have 15 days left. The January options have 43 days left. When I sell premium, my ideal window of time is between 20 and 40 days left. With the December options with only 15 days left, could we trade the December options? Yes, but we don't have a lot of time there. Meaning if we're not right away, we're not going to have a lot of time to make an adjustment on the trade or give it time to let the trade work out. So for me, I want to go farther out. I want to go out into January with 43 days left. Okay, there's some other factors that we don't have time to talk about today, but when you start to trade options that are closer to expiration, there's other factors that are working against you, and I want to try to avoid that. So we're going to go out farther in time. We're going to be a little more conservative, and we're going to open up the January options with 43 days left. Okay, and I want to try to sell a put spread here. So when I sell options, what I want to try to do is sell out of the money options, meaning I want to sell a contract that has a very low chance of success. Okay, so remember, we looked at the chart. We want to be slightly bullish. We want to play a short-term potential bounce higher. So what I'm going to do is I'm going to come in here and I'm going to look at selling the 12.5, 11.5 put spread. So what this trade has me doing, I'm going out into January. I'm selling the 12.5 put, and then I'm buying the 11.5 put to make it a hedged position. I do not like to sell naked options. Not a big fan of it. I don't like the big risk there. I like to be risk defined. I like to be able to keep my risk very small. I'm looking for small winners consistently over time. So we're going to go out and buy the 11.5 put at the same time. So now we know exactly what our maximum profit could be. We know what our maximum loss could be. Okay, I feel a lot better about that rather than taking undefined risk, which you can get when you're trading naked options. Okay, so we're collecting 34 cents here to put the trade on. Let's break this down in a little more detail. So if I pop this up, we're bullish on USO. We're collecting 34 cents to sell the put spread. Our break-even point is calculated by taking our short strike, that 12.5 put. We're going to subtract 34 cents, and our break-even price is 12.16. Okay, so now as long as USO closes above 12.16, I can make money. I don't care if it goes straight to the moon. If it goes higher, I make money. If it goes sideways, I can still make money. If it goes slightly lower, I can still make money as long as it closes above 12.16. So now what I'm doing here, I'm taking some of the directional pressure off of the trade. If I were to just buy a long call here, I have to have USO move up in a big way very quickly. Now I'm putting on a trade that takes some of that pressure off. Okay, so if USO, if we get into this trade and USO starts to consolidate here, starts to get choppy, I don't care if USO closes at 12.17 come January. I still make money and I get to keep my entire 34 cents. Okay, so the 34 cents, that gives me $34 of profit potential per spread. Doesn't seem like a lot of money, right? The great part about this trade, it's only tying up $66 of capital. Okay, that's calculated by taking the difference between the strikes here. There's a dollar-wide difference between 12.5 and 11.5, and we're subtracting our 34-cent credit. That gives us our maximum loss. So we're tying up 66 bucks of capital here. I mean, this is a very reasonable trade for many of you. I mean, we could put this trade on 10 times and still have less than 700 bucks at risk. Okay, that's the cool part about these trades. Now, some of you might be looking at that saying, okay, so we're risking 2 to make 1? That doesn't seem like a great reward to risk ratio. Well, there's a trade-off here. Okay, you're right. We're risking more to make less money, but here's the trade-off. Remember, we make money if the market moves higher, sideways, or slightly lower, so we can potentially make money in 3 different types of market movements. We also make money when time decay adds up. So no longer is that time decay working against us, it's working for us. So we're making more money every day that we hold the trade. And we're also making money if volatility decreases. Remember, we established right off the top that volatility was elevated. It was above the 50th percentile. So now we make money in 5 different market scenarios. So even though we don't have a great reward to risk ratio initially, we have so many different ways of being profitable. These are the types of trades that I love to do. Doesn't mean they're going to be perfect, doesn't mean we're going to have a 100% success rate, but when you can start to give yourself more outs, meaning you don't have to be perfect. Okay, we have 5 different ways of making money. I like that feature. Okay, when you start to approach the markets like this, I know it's very different than what a lot of people teach. Okay, even though it's a little bit more complex, there's a little bit more layers involved here. When you start to increase your odds, when you start to give yourself more ways of being profitable, you're going to start to really approach the markets very different. You're going to start to see your P&L totally change. You're going to see your equity curve smoothing out over time. Okay, that's exactly what I want. Is it fun to have those home run trades where you buy a long call and the market makes a big move to the upside and you book a 500% winner? Sure, I mean, those are dream trades. Do they happen often enough? No. Okay, so I would much rather give up the home run trade if it means I can book more consistent small winners over time. It's so much easier for me to handle psychologically. What I don't like to have happen is if I have one home run winning trade and then I follow it up with 10 losers. Okay, no one wants to win 1 out of 10 trades or 1 out of 11 trades, right? I'd rather completely flip that around. I'd rather win, 10 out of 11, 9 out of 11. I mean, that's what I'm looking for when I approach the markets this way. Okay, so really great trade here. It meets our criteria. It's now trading for 35 cents, so now we can collect $35 per spread. Again, just a great way to get involved in the markets, very little risk. Okay, it's a defined risk trade. You don't have to worry about the unlimited risk there. Get the trade on, move on with your day. It's just a great position to be in. So I'll continue to track this trade here in the coming days and weeks. We'll see how it reacts here. Remember, we've got 43 days left, so we can hold this trade for a number of weeks. Just let that time decay add up for us. So that's our trade of the week, and we'll continue to track it here over the next few weeks. So I'll be back with you later in the week with the next video.